Kangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB on this Friday. I'm Andrew Gagan. Thanks for joining us as we get across the day and the week, sum it up. And well, look, Australian shares started with so much promise this morning and it's turned into a bit of a Friday fizzle, quite frankly. It looks as though we're going to finish up around 1/5%. Mind you, we're heading towards the fourth consecutive monthly gain, given this is the last day of July. But obviously we saw a rally on Wall Street overnight and, oh my goodness, South Korea, have you seen that? The KOSPI up more than 17%, 17% today. And it goes without saying that's an intraday record. That was driven by Samsung and SK Hynix. Those two key stocks have proved to be volatile though, of course. Let's get to the themes of the day then. Winning week will take it up around 2.5% for the week. In fact, on the S&P ASX 200. K-pop, clever. That's coming to us from our producer Varma in terms of what we're seeing on the Korean market at the moment. And earnings ahead, well, obviously we're in the midst of earnings season stateside, but brace for it, reporting season beginning locally on Monday. Not a lot of results coming through, but obviously that'll start to trickle and build as we get through the week and into the month of August. Let's catch across the sectors, those movers today. Healthcare took it in the neck. CSL down around 4%, ResMed, Sonic Healthcare, Cochlear. So that was the worst performing sector as such. Elsewhere, as far as the miners are concerned, largely positive, led by the likes of BHP and Rio. Mind you, Fortescue out with an update today, so it has turned negative, just in terms of an impairment that it's warning the market of when it reports later. And taking a deeper dive into the resources, the gold mine is doing well today, led by Newmont, up more than 3%. And tech, well, goodness, as I said, seen what's going on Wall Street. And also Korea hasn't played out here. WiseTech down 5%, Xero, Life360, Tech One, they're all in the red today. Let's get to the top stories of the day then. Origin Energy, it's edged higher after its Octopus business added 2.2 million customers in FY26, supporting the retailer's continued international expansion. Fortescue, as I mentioned there, falling after flagging a $746 million after-tax impairment of its Iron Bridge magnetite project. Monadelphous advancing after securing a $165 million Rio contract for infrastructure works at its project in WA's Pilbara. Main Pharma falling after reporting a 33% fall in FY26 underlying pre-tax earnings to around $32 million. Web Travel is facing a class action from Slater and Gordon alleging misleading earnings margins guidance and breaches of continuous disclosure obligations. Michael Hill International, it rose after forecasting FY26 comparable EBIT growth of between 44 and 57% following same-store sales growth across Australia, Canada and New Zealand. Ora Banda surging after drilling extended its newly discovered Sapphire Iodes at its Little Gem Gold project in WA. Pepper Money advanced after securing a servicing role for HSBC's Australian home loan and personal loan portfolio. So let's unpack the week, as we do on a Friday, with Shane Oliver from AMP. Shane, welcome back to you. Okay, let's start in Korea. Shane, what is going on? The KOSPI up around 17 or 18%. This is quite incredible.
It certainly is, but of course that followed a huge fall over the last few weeks and to the lows yesterday. And of course there was obviously a whole bunch of factors there. The Korean share market had more than doubled year to date, massive gains in the KOSPI on the back of the AI boom. So the Korean share market being dominated by SK Hynix and Samsung, both chip makers. So they're in big demand as the AI data center boom continues. So that's propelled the share market higher. It then got overbought. The regulators moved in to try and slow it down a little bit. And of course, they've done that. And then that set off a process of investors unwinding their positions including a US hedge fund, which had been set up a little while ago by someone I think he used to be working at OpenAI. That hedge fund had taken big leverage positions in various AI-related trades, including parts of the Korean share market. I think SK Hynix was part of that. And then, of course, as they unwound those leverage positions, it accelerated the downswing. Then, of course, overnight we learned that the process of them selling down their positions has come to an end. That hedge fund has been taken over by Citadel, another hedge fund. And, of course, it may be a sign that that excessive selling is over. And that, of course, has helped the Korean share market rebound today. Now, of course, in a big picture sense, someone who knows a bit of history about markets would say, well, this is the sort of thing you might see in a bear market. So it doesn't necessarily mean that we've got the bottom just yet. I mean, it could be. I think there's a good chance that the AI story has further to run from here. It's still relatively early days in the CapEx build out. Demand for AI is real. It's not imaginary. People are actually increasingly using it and companies increasingly using it. So arguably it still has further to go. But by the same token, this process is the sort of thing you often see in bear markets. You have this huge run up, big fall, bounces along the way, and then of course at the end of the day you still keep going down. So you've got to be a little bit careful through these sorts of volatile times, and obviously investors need to keep an eye on it to see whether we are seeing a decent bounce in chip stocks, Korean share market generally. If we are, then that's good news for the wider AI trade in the US. If not, then there could be more volatility ahead.
Yeah, so I mean, obviously key results on Wall Street this week: Apple, Amazon, Meta, Microsoft. I mean, showing the focus very much on just how much money they're spending on this AI build out, and increasingly concerns from investors about where the returns are.
That's right, whether it's too much. You know, we saw in the late 1990s a massive build out with the telco, the telecommunication component associated with the internet. That, of course, turned out to be an overbuild because it was discovered that you could send more stuff down the same size pipe, so to speak, down the same size wire. You know, we worked out we could supercharge copper wiring, for example, which we did for many years, and many houses still rely on it as the fibre optic slowly rolls out across Australia. So, yeah, it turned out there was an overbuild back then. Maybe the same thing will happen this time around. By the same token, when I look at hardware investment generally in the US, it's booming. We know that. We saw that in the GDP numbers overnight. But as a share of GDP, you could argue that it's still below the levels that we saw back in the late 90s, early 2000 period. And therefore, you can make an argument that maybe it's got further to run. But obviously, it does come with big risks. And so that's why we're getting this sort of twitchiness in markets at present. So it's not just oil, it's not just the Fed, but you've also got this uncertainty about around the AI story. But so far, if you look at the numbers coming out on the profit side, something like 86, I think 87% when I updated the numbers this morning. So we're about 60% of the way through the profit reporting season in the US for the June quarter. Something like 86, 87% of companies have outperformed. That included Amazon overnight. Last week it included Alphabet. But sometimes you're getting these mixed reactions to them. We saw that last week with Alphabet, that they're shooting the lights out, but investors starting to worry there's too much CapEx going on. So overall, the numbers we're getting out of the US are very, very good. 28% profit growth on the most recent update from combining consensus with actual results for the quarter to date. And that compares to 29% in the previous quarter. So that's exceptionally strong, and it does underpin good gains in the US share market. But obviously some are worried that may not be sustainable, and that's where the volatility comes in.
Now, Shane, the other big event stateside this week was the Fed meeting. We did hear from Kevin Warsh, chairing his second meeting. What do you make of the fact, look, obviously dot plots are gone, he's not giving forward guidance, he said that's up to the markets to determine where these rates are going. How do you sum up his communication at the moment?
Well, I kind of wonder whether he read that quote from Alan Greenspan many, many years ago, where Alan Greenspan said something to the effect that if you understood if you think you understood what I said, then I've misspoken. And so consequently, he talks in riddles. He was asked, what do you mean by the 2% inflation target? I mean, the standard answer would be, I would think, the core private final consumption deflator in the US. In Australia, of course, it's the trim mean, or it's the rate of inflation over time at 2.5%. And of course, they use as a guide to that the trim mean. So it should be quite clear, but the answer was this long paragraph of sentences which sort of implied that it could be anything, and that left the market confused. I think the market was also after for some clarity as to what the Fed would do, what their reaction function would be if inflation stays too high. Would they raise interest rates? And he said something to the effect like, well, that could be part of the answer, but there might be other things. And everyone's saying, well, what are these other things? So all of that has created confusion, I think, and to some degree the Fed's lost a bit of credibility in the process. I mean, you might say, well, you've got a new governor. Oftentimes they go through a teething experience. Their comms are not quite right, and then they get it right. Jerome Powell went through the same thing, but I think this one's a little bit more complicated than that. And that does get me a little bit worried that we end up with the Fed losing inflation credibility, even though an ultra dove was not appointed to the Fed. Don't forget, it could have been Kevin Warsh. It turned out to be Kevin Hassett. Turned out to be Kevin Warsh. So the market breathed a sigh of relief, and here we are. We're confused as to what exactly the Fed's trying to do. So that could be a bit of a problem, unfortunately. And if you're Donald Trump, obviously he wants lower interest rates, but that could be a bad thing for him, because if the Fed does appear too dovish and not responsive enough to inflation problems, then ultimately that could lead to higher interest rates, whether you like it or not, and the bond market will vote with their feet. And maybe that's what we've been seeing lately. The bond vigilantes are back out there saying this is a bit of a problem, and bond yields have been trending higher.
Yeah, well, that's what Kevin Warsh essentially alluded to as far as the market's going to do its work. Shane, whereas you could argue the communication has been clear here from the RBA, they obviously remaining hawkish just as far as saying inflation obviously remaining above target band there. Nonetheless, given those figures we got midweek on quarterly CPI, what did you make of that? What are the chances? I mean, certainly you look at consensus, maybe not consensus, but many economists now thinking, well, a hike, I should say, is off the table in August.
Like, it probably is. There was a speech on Tuesday, the CPI on Wednesday, and then there was some comments by Sarah Hunter, the chief economist at the RBA, on Thursday. I thought the speech by the governor on Tuesday was a bit hawkish. Some would say that there were some dovish increments to that speech, and that's why the market sort of started to get more relaxed. She said that the jobs figures have been a bit weaker than expected, and the housing market's been a bit weaker than expected. Now we've got weaker than expected inflation numbers, and that added to the dovishness from the RBA in terms of what the RBA might do. That's why the money market, as of today, when I last looked, was saying something like less than a 1% chance of a hike in August. So well and good. The only qualifications to that were, and you can see the numbers there, the inflation numbers have gone up, the trim mean has gone higher, but the monthly trim mean has been stuck around 3.6%, and the quarterly did edge up a little bit, but not much. So you can sort of say, well, maybe we're at the top on trim mean inflation. It's nowhere near where it got to back in 2022. So therefore, maybe we're near the top on interest rates as well. I mean, the counter argument to that is the chart that was put up just before this one, which shows the proportion of items in the CPI that have inflation for those items running above 3% versus below 2%. And you can see for the red line above 3%, there's more items above 3% inflation than below 2%, which in other words tells you the breadth of inflation still remains unfavourable. It's not like that period in 2024, early 2025, when the green line was above the red line. So that's a bit of a concern. 3.6% underlying inflation still too high. The petrol price has gone back up again. I last looked, $1.95 a litre. End of last month, $1.53. So you're going to get a big boost to inflation from that. So therefore, the fall in headline inflation may not continue. We're yet to see the second round effects from the rise in oil prices. And of course, you could argue that the RBA's credibility is on the line to a greater degree today than it was back in 2024 or 2025, because we've seen this latest spike in inflation. We're now going to have 5 years out of 6 where inflation's above target. So all those arguments, I think, to me, tell me that, yes, there is scope for the RBA to leave rates on hold in 2 weeks' time, in August, but they're probably still going to want to sound fairly tough, fairly hawkish, consistent with what Sarah Hunter was saying. They're still committed to keeping the inflation rate down and making sure inflation expectations doesn't rise. So they'll still be out there signalling, I think, that if anything, they still may have to raise rates again. And in our view, they probably will, because I don't think inflation's going to come down quickly enough. It's you can sort of debate all over this this issue at present, because we do have a weakening in the property market. The jobs market is a little bit calmer or cooler than it was 6-12 months ago. Consumer confidence is very low, so that's why there's a lot of debate around this. But I think whichever way you cut it, we're a long way away from rate cuts. I think that's a story probably for the second half next year.
Well, Shane, you've reminded me, I better go and fill up my car on the weekend before it all goes north again, as far as petrol's concerned. Yes.
This time next week, we might be 17 cents higher.
Oh, goodness.
A litre.
Well, in the meantime, enjoy your weekend. Thanks for joining us on AMP, Shane.
Thanks, Andrew. Take care. You too.
All right, let's get to our stock of the day. Now, it was a small cap special. That in mind, we looked at Advanced Energy, shares having plummeted, with the company cutting its FY26 financial guidance. Our experts, Luke Winchester from Area of the Capital and Richard Hemming from Under the Radar, had a look.
Sort of grant Advanced Energy, the fact that most of this does sound like it's external factors that's weighing on them. But this is why investors do like to take a back seat. Give a company a few years in the listed environment. How do you handle giving guidance? How do you handle investor relations? Because a few years ago, if something like this happens to Advanced Energy, it's a private company, business is weak for a period or two and then things bounce back. Now you're managing an investor base. Now you're managing a public share price that's down 30-something% today. And it's a very different ball game. And that's why a lot of people, will wait to see what it looks like.
A company can IPO and disappoint and then recover, like Collins Foods, a great example. But and this does definitely seem like a good company, like it's a serious company. They have serious sales and they look the goods, but it's just that like they sold on the expectation that they would deliver 60 million equivalent EBITDA, and now 60 Australian EBITDA. Now it's like 40, and people bought at $1, and now I'm just thinking it's just like that kind of disappointment is going to take a while to recover from.
Well, let's wrap this up then and take a look at the best and worst in today's trade then. Beginning with the leaders, 40 Medical, after the back of an update there with increased sales contracts there, close to 12% higher. Megaport also doing well among, a bit of a mover, whereas most of the tech stocks actually fell today. Electro-optic systems, I should say. And the gold miners doing well today, led by Firefly. Those that have fallen, WiseTech, down 5%. Domino's out with its updates today. Similarly, we've got an update from Champion Iron as well. And healthcare stocks, they're hurting, led by CSL, down around 4%. Checking in on what's happening tonight, we get inflation read out of the Eurozone for July, some commentary from the Bank of England, and US earnings continue with ExxonMobil, Chevron and Colgate-Palmolive. And next week, well, it's our turn. Earnings season kicking off. It is August. So we're going to cross some of those results, including REA, AMP and ResMed for the week ahead. US earnings continuing with SpaceX and Berkshire Hathaway, and we get some retail sales data out of the Eurozone. All right, let's sum this up then, where we are finishing close to 1/5%. Bearing in mind we were up more than 1% when we got going this morning, so a bit of a fizzle across the afternoon, but we'll take it because we're up close to 2.5% across the week on the S&P ASX 200. That is this Friday. Thanks for watching and listening.